What's up everyone, my name's Robbie. This is Robbie in Manila, and today we're talking about the best consumer discretionary ETF. This is the 10th video in our series about the best sector ETFs, and of course, today we're talking about consumer discretionary. So how is consumer discretionary done in the past? If you invested in the S&P 500 this year to date, you would have had a 15.3% return. If, however, you invested in the consumer discretionary sector, you would have had a 10.3% return. So consumer discretionary this year underperformed the S&P 500. But some years it has outperformed. For example, in 2020, it had a 33.3% return, where the S&P had an 18.4% return. So going back, consumer discretionary does have quite a few years where it does outperform the S&P 500. So I think we're ready. Let's go ahead and find the best consumer discretionary ETF. So let's go ahead and get started. But first, please, in the comments below, let me know, are you investing in consumer discretionary right now and why? So today we're going over 4 different ETFs in the consumer discretionary sector. The first ETF we're talking about today is VCR, which is the Vanguard Consumer Discretionary Index Fund ETF shares. Then we have ticker VDIS, the Fidelity MSCI Consumer Discretionary Index ETF. Then we have the XLY, Consumer Discretionary Select Sector Spider Fund. And finally, we have RCD, which is the Invesco S&P 500 Equal Weighted Consumer Discretionary ETF. As always, let's go ahead and start first with the expense ratios and see how those look. For VCR, we have an expense ratio of 0.10%. For FDIS, we have an expense ratio of 0.084%. For XLY, we have 0.12%, and then RCD, we have 0.40%. So obviously RCD has a much higher expense ratio than the other ETFs, so we're going to question that and say, is it really give you something that is worth 0.40%? So that's one of the things we're going to think about. The next thing we want to go over is the weighting scheme of these ETFs. So all of them are market cap weighted except for the RCD ETF, which is equally weighted. If you're not sure about equally weighted versus market cap weighted, basically a market cap weighted portfolio means that the larger companies, based on market cap, will have a higher weighting in the portfolio. So a giant company like a Google, a Microsoft, Amazon, they're going to be a higher portion of the portfolio than in an equally weighted portfolio. In an equally weighted portfolio, all of the stocks would have an equal weighting. Hopefully that makes sense. So next we have the distribution yield. So are you into dividend investing? Do you like yield? Basically, these aren't big yield paying ETFs. You're going to see a distribution yield here for VCR of 0.60, FDIS 0.50, XLY 0.53, RCD 0.40. So they're all very similar. I'm not seeing anything that's really standing out on this one. Fundamentally, actually, some of these are a bit different than the others. So price to earnings ratios, for example, for RCD is much less than the price to earnings ratio for the other 3. So XLY is the highest PE ratio of 30.8. RCD is a 19.9. So RCD is a bit cheaper in terms of earnings. Also on a price to book ratio scale, it's a lot cheaper as well with a 3.9 versus XLY with the highest price to book value of 8.8. So maybe RCD is a bit more of a value oriented ETF than the other 3. Moving on to Morningstar ratings, let's take a look first at the 5-year ratings. So we have one 5-star fund, which is FDIS in the 5-year category. VCR is a 4-star, XLY 4-star, and then RCD is a 2-star. For the 3-year rating, FDIS is also a 5-star. And unfortunately, there's no 10-year rating for FDIS, but it looks like generally FDIS has the best ratings out of these 4 ETFs. Let's start with the 5-year return. So we have a 5-year return here. VCR 23.21. FDIS 23.61, XLY 21.56, and RCD 12.14. So RCD definitely not doing good on the 5-year return. Is it also bad on the 3-year? It is. On the 10-year, it also is. So from a return perspective, these ETFs are very close. They're all well within 1% of each other for most of the year's returns. Taking a look at the portfolio, for example, VCR, the top is Amazon, FDIS is Amazon, XLY, Amazon, and RCD is Ford Motor. Of course, RCD is an equally weighted portfolio, so it's going to have more of a closer weighting for all of the different stocks. You have Tesla in all of these, you have Home Depot, so a lot of these are very similar for the top few holdings. So of course, they're consumer discretionary companies that people usually will spend money on that they don't necessarily need, so they're not consumer staples, it's consumer discretionary. The final thing I like to look at are the sizes of the companies. So VCR is 47.17% giant cap companies. FDIS is also close to that, and XLY is higher. RCD is very small on the giant cap companies. VCR and FDIS are close on the large cap, and then a little bit more on XLY. And then in the medium cap category, small and micro, VCR and FDIS are very similar. XLY doesn't have much micro or small, but it does have quite a bit of medium cap companies. So now we have to pick a winner. Now I'm not seeing much difference in these ETFs. They're all very similar. They're good ETFs. So what I'm going to do is I'm going to base this one on the expense ratio. So we're going to just go with the lowest expense ratio because I don't see any better returns in these other ETFs. So might as well just go for the cheaper one. Why not? So basically we're going to go FDIS is the winner with a 0.084% expense ratio. How is FDIS done versus the S&P 500 index, which we're looking at via VOO, the ETF VOO, which is a Vanguard ETF? As you can see, FDIS has done a lot better than the S&P 500, so that's actually really great. Right now we're looking at a 5-year return. Because there's no 10-year data, we can't look that far back. So this is for a 5-year return, and so this is actually looking pretty good. Now the next thing I want to look at is some technical analysis of FDIS. So in terms of indicators, the first thing I'm looking at is RSI actually looks pretty decent. It's not quite oversold yet, but it is pretty far down there. So that's not necessarily a bad thing. Probably going to give that a check mark for being a positive. So what I'm doing here is I'm just looking at some support and resistance lines. Looks like the 83 area is going to have some potential resistance. And if you see a bounce off here, it could potentially go up to 92. So what would I do here? Well, I might just wait and see if this thing comes back down and retests this area. And if it does, could be a good play to go back up to 92. And then maybe it potentially goes further up. So that's all I have for this video. Thanks so much for watching. I hope you enjoyed it. And if you did, please hit that like button, subscribe to see future content like this. And you should totally watch another one of my videos. It's coming up. It's on the end screen right now.